everyone, and thank you for joining me. I was at the Silver and Gold Summit in San Francisco just a few months ago in October, and I was on a panel, and they were asking during the panel, what recommendation do you have for how much money someone should have allocated to gold in their portfolio? And the common answer was 10% or 20% or some other allocation. Got to me, I said, I have over 100% of the value of my portfolio in gold. And when I did, I said, but I have an options strategy around it that limited my risk to no more than 5% of my capital. And when I shared that story with everybody, almost immediately, I got huge feedback, and everyone wanted to know what I did and how I did it. So I wanted to just come out here and share with all of you the actual strategy which I'm doing with real money. And so all of you can learn to do this for yourselves. So I want to talk about gold. And I'm going to use GLD as our example. This can be done in the gold futures market as well, but we're talking about physical gold. And we're actually owning the gold. Yesterday when I was talking about using options as an alternative to owning stocks. But today we're actually going to physically own the GLD shares. And what we're going to do is we're going to use the options as insurance. So what you want to think of the strategy is it's very similar to buying insurance on your car. And what happens is that, well, first of all, how many of you have insurance on your car? How many of you like paying for your car insurance? How many are excited to get that bill in the mail, right? No one likes to pay for it, but when you crash your car, or not when, if you crash your car, how many of you glad you had it? And so what you want to think of the same way, we on individual stocks, or in this case gold, can actually buy an option, in this case a put option, that gives us a guaranteed sale price at a fixed price over a fixed period of time that removes the downside risk of loss to a fixed amount, like a deductible or something like on those lines. And so we're going to be using that option in this example as a way to hedge a highly leveraged position in gold. And I say highly leveraged because how diversified am I if I put 100% of the value of my portfolio in gold? That's not very much diversification. But to me, that's actually important. Let me ask you, if any of all of you just allocated 10% to your gold of your portfolio to gold, and gold went 100%, how much is your portfolio up? 10%. I mean, is that you're at the VRIC at this gold conference to get a 10% kick in your portfolio? Or are you here because you're looking to make real returns? The thing is that at some point you have to take a high conviction to make really good money. But the problem is, how do you take a high conviction position and if you're wrong, don't lose a lot? And that's where I want to talk about this in greater detail. I'm going to talk about this through an option strategy called a collar. And what we're essentially doing is by selling calls, which I'll explain in a moment, we're able to harvest an income from the gold to pay for the insurance. Earlier, we were just talking about that nobody likes to buy or pay for their insurance. But what if we can go and actually find a way to put this trade on at almost no cost to us? Well, that's what I want to share with all of you here. So let's actually get into it and talk about this collar strategy and how it works. But the first thing I want to do is talk about George Soros. And for all the politics, he still is going to go down as one of the greatest traders of all time. This man just learns how to print money. It's like he's a central bank. He's a really smart trader. But I want to emphasize the point he makes. He says, it's not whether you're right or wrong that is important, but it's how much money you make when you are right and how much you lose when you're wrong. That makes sense, doesn't it? So what I want to do is I want to explain to you why asymmetry, this idea of losing small when we're wrong and winning big when we're right, exists in the gold market. So let me share this with you. So what I want to talk first, we're going to use the GLD in this example. Those of you that want to use gold futures, a similar style opportunity exists in the futures market as well. But for the sake of this, we're going to use the GLD ETF. All of you can go out into the market right now, buy physical GLD shares, and have exposure to the upside of gold, right? And so you can buy and own it in your portfolio. On Friday, it was trading at $146.58. All the prices I'm going to share with you were Friday's closing prices, and will probably be not much different Tuesday morning when the market opens. So what I want to do is I want to cover with you the reasons why this asymmetry exists in gold. So the first reason this exists is because of the term structure of gold and gold futures, which is that the forward price of gold is actually always at a higher price than its spot price of gold. Now, this exists. Storage costs and all sorts of other things. I'm not going to get into all the nitty-gritties of why it exists. But what you want to take away is that when we're doing a collar, let's say 6 months out or a year out, we're using, for put-call parity purposes, a higher midpoint where the put-call parity exists. It's always at a higher price in gold. That's the first reason. The second reason is the way that the option skew works in the gold market. Now, I don't have time in this 20 minutes to go into detail as to what the skew is and how it works. But I want to explain to you by illustration how dynamically different the skew exists in the gold market versus the normal market. So I have the S&P 500, largest market in the world. And what you're looking at is the option skew, which is influencing how expensive calls and puts are on the S&P 500. And what you want to observe is that when I take the S&P 500, in this case we're using the SPY, and we look at a put option to buy insurance, 10% lower on the market, you want to notice that that circle, when we're going to the left, is actually much higher than when we go 10% forward in the price of the S&P 500, which is the income you would earn on the call. What you will see in the normal S&P 500 market, the insurance is very expensive because everyone is worried about the S&P crashing, and they're paying very rich premiums to actually buy the puts. At the same time, the calls are actually really cheap. It's actually very hard to build a collar in the S&P 500 market that is free or low cost. It's almost always that the insurance costs more than you collect in income. But let's take a look at gold. Now, isn't this interesting? The skew actually is the opposite. What you can see is that if we go 5% lower on the GLD, you actually can buy relatively cheap put insurance. And when we go, let's say, 5% out of the money on selling a call premium for income, we can actually get a very rich income to earn as credit. So in combination with the first point, we have this amazing opportunity to actually build very low to almost no cost straddles, or it's not straddle collars, on gold. Now remember, we physically own gold shares. What we're trying to do is build a strategy that hedges around the gold position that we have every intention to hold over the longer term. So what I did was I snagged a quote on gold options going out to June of this year. So we're going out 150 some odd days. We're going out about half a year. But what I want you to observe is this. The GLD is at $146 and change. A covered call going to $165, which is about $19 higher, can earn us $1 income. We receive a credit for $1. Imagine $100 for every 100 shares of GLD coming into your account and paid to you as income. At the same time, a put option, just $7 lower on the GLD, is also just about $1. We can essentially earn $1 income at the $165 strike and use the dollar to pay for an insurance policy at the $139 strike, and it literally cost us zero. It cost us nothing out of our pocket to actually put this collar on. So now, what I want to illustrate here is, like George Soros was talking about, how much you lose versus how much you make when you're right. Do you not see asymmetry in the opportunity we created? It cost us nothing to put this trade on from an options perspective, yet we've limited our downside risk to 5%, and yet we're giving ourselves 13% upside potential. Isn't that amazing? And so now everybody is so worried about how much gold I have, and every tick higher and lower in gold is making you nervous. But now if you put this collar on, you can sleep at night. You can take a decisive position believing that gold is going higher, and at the same time you know what your risk is limited to. So I want to now talk about a third advantage. So there's a third advantage to this that is beyond the asymmetry of the zero-cost collar. I want all of you to now picture, or many of you may already own the GLD, but I want any of you to picture what it felt like during 2016 and 2018 when the GLD went through two market corrections that were about close to $20 to $25 in size. The GLD started dropping. Just imagine being a GLD owner, and every day you see it down $1, and then you load it in, and then now down another $1, and then you load it up the next day and it's down another $2. You know that knot in your stomach, that feeling that, like, I really love gold, I believe in it, but it's the pain you feel when you are in a big position. Imagine even having 100% of your allocation to this. It doesn't feel good. Can we agree on this? Well, let me tell you something. When I'm in my GLD position, I actually have a different attitude. If it's going to go down, it might as well crash and go down a lot. I'm actually cheering the GLD down while I'm in. Why? Because I've secured a guaranteed $139 sale price. If the GLD right now at 146 started to nosedive and was going down autopilot to $120 a share, what am I going to be able to do? I can sell all my GLD shares at 139 and buy it all back at 120, reducing my break even, and actually I start making money from a lower cost base on the way back up. How many of you are fully leveraged into a position and are cheering it to go down? When you use options in combination with your investments, you actually have the tactical ability to manage your positions in both directions. It changes the way you feel when you're investing. There's another element that I want to talk about, and it's the idea that many of you will say, well, Patrick, I honestly think that gold's going to 2,000, 3,000. You just cut off the upside of gold at $165. You just capped yourself. I don't want to cap myself on the upside of gold because I'm a believer. We don't ever allow ourselves to lose the stock. I always say to even for myself, or whether it's for my members, I always say, I wish the curse upon all of you that the stock is going up too fast, too quickly. That the problem is that we're reaching the upper boundary of the call, right? The problem is the GLD is just going up too fast. Well, once you're in a situation where your GLD shares are making you all of this money on the upside, even though you might be losing some money on that call, you can always close the call position. You could always sell it at a higher price. You never have to just commit to selling the position at 165. You have so much flexibility what to do once the position is moving in your favor. The point is that when you use options as a strategic tool to trade around your positions, you have the ability to actually be in control. That feeling that you know that you can take a high conviction idea, put even 100% of your capital behind an idea, and know that when you're wrong, you can lose a small amount that's defined, that you knew in advance what your worst case scenario was. But yet, when you're right and making you money, you have the opportunity to fully capitalize on the profit opportunity that is before you. The only people that can take advantage of this are the people that take the time to educate themselves on how options work and how to use them. I welcome all of you to join me at Big Picture Trading for a complimentary access where I currently have this trade on. We actually republished it for members on Friday, and you could follow along and see how I'm doing this. All of you can come by the booth. We're here at 11:35, just a little bit to the left here outside there. And you can have the conversation with us and get a complimentary access to membership and see how we do this and whether it's right for you. And those of you watching online, you can just go to bigpicturetrading.com. Otherwise, thank you very much, everyone, and enjoy the rest of the show.